Good morning, everybody. I'll be filming today from the beautiful beaches of South Carolina. The sun's a little bright this morning, and so I'm probably going to move in for the rest of this video. But today I want to talk about two things. One is I saw some videos online about the psychology of investing and some of the pitfalls for that. I want to talk through some of those and how dividend investing can actually help contradict those, I guess. The other thing I'd like to do is give you some insight onto a high yield stock that I own. It's called Hess Midstream Partners. It's a company that transports either crude or natural gas through their pipelines. So they're basically in the midstream of the petroleum industry. They're located up in the North-South Dakota area, and but I wanted to get your thoughts on it to see, what you think of this company. It is a higher yielding stock. It's in the it's greater than 6%. There's times that it was nearly 8%, and it may be even there today. So just want to go through that and give you some details around that and why I'm interested in them, and then get your thoughts on that. So with that, grab your cup of coffee and let's get to it. Okay, I'm back inside now. I have my coffee. Hopefully you do as well, and let's go ahead and get started. Okay, so I was watching some videos this past week. I don't remember who posted it, but it had to do with psychological impacts for investors and pitfalls to watch out for. So what I thought I would do is kind of walk through those and then walk through how I believe that dividend stock and dividend growth investing actually helps me counteract some of those. There's obviously never a foolproof way of doing this, but it at least gives me some foundation by which to counteract some of the things that as humans we see when we're investing. So moving forward, I'll talk about the pitfall, and then I'll talk about the benefit of dividend growth investing. So anchoring is being fixated on a price, resulting in fear of averaging up. And so basically, as a stock does better over time, you get fixated on the first price that you bought it for, which might be cheaper, and then you don't buy any more of it because you're afraid to average up in price. So this is, again, just a psychological thing that some people deal with. Maybe you don't, but some people do. And from a dividend growth investing perspective, I'm going to see if I can get rid of this. There, that's as good as I can do. Dividend growth investing then focuses on dividend growth and yield, not mainly the share price of the stock. And so basically cash is king. And so we're looking at cash, not looking at the price of the stock. So we're less worried about anchoring. The second one was panic buying. And then basically it's a fear of missing out on the gains from a fast rising stock. So a stock that comes into popularity that might be shooting up, like this new EV stock, I forget the name of it, that came out this past week. It just, shot up and everybody was going after that. There's a panic buying, just being afraid of missing out on the next big thing. So what dividend stock investing does is it prefers stocks that are trading at or below fair value, causing less chasing of stock prices. And in essence, we don't want to overpay. We know that we're making money when we buy a stock. And so again, if we're following the principles of dividend growth investing, we have less chance of getting caught up in this panic buying. The third thing was regret theory and the fear of regretting a current decision sometime in the future. So, it's like you buy a stock and that you're going to regret it if it goes down. And so there's this fear that you're going to regret any decision you make. And it leads to analysis paralysis, so you end up not making any decisions sometimes because of that fear. So what dividend stock or dividend growth investing does for me is it provides comfort that the investor is receiving a good value. And I go back to the old adage by Benjamin Graham: price is what you pay, value is what you get. So as long as I'm getting a good value for what I'm paying, I'm comfortable, and I know I'm not going to regret that decision. Even if the stock price goes down, I know that the value was there. So the fourth one is loss aversion, and that's when there's more pain felt in a loss than joy is felt in a similar gain. So if I buy a stock and it goes down by $1,000, there's in this loss aversion aspect, I would feel that more. I would feel that $1,000 pain more than if the stock had gone up $1,000. I wouldn't feel as much joy with the gain in the $1,000 as I would feel pain in the loss of $1,000. So what dividend growth investing does for me is it views price declines as opportunities to purchase additional valuable stocks at even a lower price. And again, we make money on the buy. So if the stock goes down, that's a great thing. It gives us an opportunity to buy more of it at a cheaper price. So, because again, we're looking for value. Not the last thing, but the next thing is survivorship bias. This is a little bit harder to grasp, but what we have in the stock market today are those companies who still survive. So when people are out there chasing the next Amazon, the next Facebook, the next Microsoft, the next Apple, they're chasing something, and the only data points they have to compare that thing to are the survivors who have who have weathered the storm, and those survivors who have done very well. You don't see in the data and in the analysis the companies that are no longer around, those who started that never made it. And so as you're chasing these shooting stars, you only see the ones that made it. You don't necessarily see the ones that didn't. So in your analysis, it's important to understand that you're only seeing data from companies that have survived. So how does dividend growth investing counteract this to some extent? And it focuses on stocks with consistent growing dividends supported by solid cash from operations. So there's consistency here. There's consistency not only in their performance, but also in the characteristics that you look for in their balance sheets. They're going to have strong cash growth. They're going to have solid credit ratings. They're going to have great balance sheets. And so there's these consistent triggers that you look for in these companies. And so that kind of helps counteract that survivorship bias. And the last one they talked about was our short attention spans. And this is absolutely true. We're in a society today where media is a soundbite. And so we want everything in a TikTok video. We want everything in a reel. And so then we want to move on to something else. So it's basically a lack of due diligence in our stock selection. So if we take that short attention span and apply it to our investing, it causes us not to research stocks well enough. And then once we do research them and buy them, it causes us not to have patience to allow them to succeed and for our investment to pay off. So how does dividend growth investing counteract that? We see companies with strategic competitive advantages requiring research of each company's strategy and financial results over a long period. There's no shortcuts to good research. And so in order to be a good dividend growth investor, we must do our research. Doesn't mean that we don't allow others to do some of that research and even pay for that research. But we do go through this research process. So why am I a dividend growth investor? I'm a dividend growth investor for all of the reasons that you see on the right-hand side. And it helps me counteract some of the psychological even whether I know them or not, issues that are arising as I look at an investment that's falling rapidly and have this desire to get out of it because it's deteriorating in value. But the dividend growth investing strategy allows me to stay in and stay in for the long haul. And I don't want this video to be too long, but I do want to mention one other thing, and that's an article that I read the other day regarding Peter Lynch, who was the investor for the Fidelity Magellan Fund back in the 77 to 1990 for a 13-year period. And he attained a 29% average annual rate of return in the Magellan Fund. But a study was done, and you should look this article up. A study was done, and the investors in his fund did not do that well. And the reason is these psychological issues. Once the stock started to tank, they pulled out, and then they were too late getting back in, and so they missed the upside. There was a study done by Morningstar that was also in the same article. And Morningstar did an analysis of a 20-year period in the stock market. And the rate of return on the stock market was an average growth of just over 7%. I don't remember the exact numbers. It was just over 7%. And if a person who is investing in the market got out of the market when it fell, or no, let me just rephrase that. If they missed the 10 best days in the market out of 5,217 days of trading days over that 20-year period, if they missed the top 10 of those days, their return went from just over 7% to about 3.5%. So at the end of the day, what's important is staying invested, it's staying in the market, and it's not being panicked by what goes on in the market. So anything we can do to counteract some of these psychological issues that we deal with from an investing perspective, I think is important. And that's why I am a dividend growth investor. And before we get started with Hess, I just wanted to point out that I woke up this morning, as many of you know, I'm a shareholder in Tyson. Tyson reported earnings this morning. They beat their earnings projection by 8 cents. And they also beat on revenue. And then even more importantly, they raised their dividend by 3%. So I woke up this morning on a Monday morning, sitting at the beach, and ended up with a 3% raise on Tyson. So passive income is the best, right? So let's move on and go to Hess Midstream. So as you see here, this is the investor relations presentation from this month. So I thought I would lay some of this out for you. They start out with, their sales pitch, right? They have, high quality portfolio, long-term contracts, et cetera, et cetera. And you guys can pull this up on their website. It's in their investor relations section. And all of these things I believe are true. I think what's important here is when we look at volume and revenue growth, I think that's going to be important because of a couple of reasons, and this is not the right slide to get to that on. So, but their long-term growth is based on, their revenue and volume, their growth in EBITDA, low capital expenditures moving forward, and a sustainable free cash flow to self-fund distributions to its shareholders. So I think and you can see the charts there. Those look pretty good. Here's an important point. 100% of their revenues are fee-based contracts, and many of those have minimum volume commitments. So not only do they get a fixed fee, but they have minimum volume commitments. So from a price risk and volume risk perspective, that risk is somewhat mitigated. And they also have fee recalculation mechanisms to deliver cash flow if necessary. So I think that's pretty interesting, actually. You can see here the adjusted EBITDA has grown significantly since 2015. I think that's a good sign. This is a map of their position, but what I want to point out here, and this is probably the biggest risk around Hess Midstream, is that they are dedicated to their strategic partner, who is Hess Petroleum. So, having one particular customer is a pretty big risk, but at the end of the day, it looks like there may be some, that may be a risk worth taking. They have three major lines of business. They're an integrated gas processing and gathering business, and you can see what their footprint is to the right on that, what their capacities are. They also do crude oil terminaling and gathering, and that's it actually overlays. It'll be an interesting chart to see it overlay, but it overlays that natural gas pipeline. And lastly, they have water services, where they dispose of water with a lot of saline in it. So, and that pretty much overlays also this natural gas and crude oil footprint. So they have focused discipline. They're only going to need about $180 million in capital next year, or this year. This is 2021. They do have a potential to acquire some additional assets in the Gulf of Mexico from Hess, and so that's something to keep an eye on. This shows their position compared to their competitors, and you can see that they're very competitive in their metrics. So here's the I guess a summary of their natural gas and their crude oil. Both of these, you can see that river flowing through. Both of these are kind of on top of each other, which is not a bad thing either. Just thought I would talk about another risk related to them, and that is it's probably easier to see here. And I'll try to blow this up a little bit so you can see it. Hess is a limited partnership, or I'm sorry, Hess Midstream Operations is a limited partnership. However, the Hess Midstream LP is not. It is a New York Stock Exchange traded company, and that company has both private placement shares as well as public shares. So you can see that the public shares after this last distribution is about 31 million plus shares. The private placement shares have 110 million on this side, plus 110 million on this side. So we basically have about 220 million shares that are in private placement. The people who own those shares, or the companies who own those shares, are Hess Corporation, as well as Global Infrastructure Partners and affiliates. So there are 50-50 owners of the private placement shares. So as the stock rises in price, their tendency will be for them to sell off some of those shares. And I've seen that last year. I also saw it again this year. And while there is some impact because you're putting more shares onto the market, it is not dilutive. And here's why. I'll show you that here in their 10Q. So if we go to the next slide here, consolidated statement of changes in partners' equity. You see there's this huge non-controlling interest. Let me shrink this back down a little bit. And in the June 30th, 2021, the net income for Hess overall was 131 million. For the Class A shares, which are the ones that I own, there was a net income of 9.9 million. That net income is for the Class A shares. The rest of the net income, the 121.2, all went to non-controlling interests, which are the non-public shares. So as these companies sell their shares moving into the future, the income associated with those shares comes with it. So while there's more shares going into the market over time, those shares come with net income that's already been associated with them. So it's not dilutive, but it does put a lot of shares into the market at one time. So one of the risks is not only do they have one customer, but they also have a sawtooth, um, growth prospect here as they, the share price grows and then they issue more shares out of private placement and it drops a bit until there's enough investors interested in the yield, and then it rises back up and they issue some more shares. So that's another risk, is that you're going to get this sawtooth approach to growth. Now, to give you a sense for what Simply Safe Dividends has to say about them, they are rated as unrated, actually, because they don't have enough information about them. The yield is 8.12% as of today. Their beta is 0.72. Their dividend growth, as you can see, is very fast, and I've been enjoying some of that, actually. So as I move forward here, you can see that there's some sawtooth action here in the annual dividends per share, and that is because there's been some special dividends that were issued, and so that shows up as dividends on this chart. However, when we look at the standard dividends that are given out on a quarterly basis, you can see that they've gone from 37 cents in February of 19, and most recently to 51 cents in this last quarter. So their dividends are growing over time. Let's see what doesn't say how long, I guess. So, but anyway, they've been growing. Here's another important point, is that because of the way the structure of Hess Midstream has been done, they actually issue a form 1099 for dividends, and they are considered qualified. So typically in these midstream operations, they're limited partnerships, and so the taxation aspects of that are a little more complicated, and I don't do complicated currently. So I like to keep it as simple as possible. So the fact that this is a 1099 and that they are considered qualified in terms of their dividends is a great point. So, and we've already seen some of these, but you can see their sales are growing, shares outstanding are lower. You see the rise here to 21.9 million. That's going to actually go on up to 31 million over time, and possibly even higher than that as these private placement shares come onto the market. Don't have any idea how quickly that happens. They just, when they do it, they do it. And this past offering was 7.5 million shares, and that was about a month or so ago. And the stock was trading around 29, 30 bucks. And then they offered these shares out at 26, and it's been trading at 26, 25 for the past few weeks here. But, as more investors get turned on to this stock, I think that will help. But so the next thing that we'll look at is, what does Seeking Alpha say about them? So Seeking Alpha has a quant rating which is neutral, and as you see here, the valuation, growth, and profitability all look pretty good. We'll look at the Wall Street analyst ratings. They are bullish. We've got 1 very bullish analyst, 4 who are bullish, and 3 who are neutral. Their average price target is 29.5. So you can see that that's not a bad return, since it's trading in the 25 range today. So that's pretty much it on Hess Midstream. I do like this stock a lot. So I thought I would give it some attention, and maybe there's something I'm not seeing. So I wanted to give you guys a chance to weigh in on that, and see if there's anything that I may be missing. So anyway, that's pretty much it for today. I hope this has been helpful. Let me know your thoughts on Hess. Let me know your thoughts on the psychological review, and whether dividend growth investing is helpful for you in that regard as well. So, and if you, I'm not an investment professional, so don't take my advice as investment advice. It is strictly for your entertainment purposes only. I am long in Hess Midstream, so do know that. And also, if this has been helpful for you, leave me some comments below. And if you like what you hear and want to hear more of it, subscribe to my videos, and I'll be looking forward to doing some more of these here in the future. Hopefully I'll do another one here at the beach, because this has been a great environment to do that in. So with that, I bid you adieu, and I'll see you on the next video.